You ready?
Yeah, let's do it.
Let's do it. Go. Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Jesse Felder. He runs the Felder Report, which is a US stock market-centric but macro newsletter. He's a co-founder of a multi-billion-dollar hedge fund, and he's got some very interesting thoughts about the market. So we're going to explore those right after this. Go.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Hi, Jesse. How you doing?
Good, Toby. Thanks for having me on.
My pleasure. Look, let's get right into it. What do you think about the US stock market?
Well, I think we're in the midst of a topping process, and I think we have been since late 17. That run up, that was a strong run up, late 17, early 18, was probably pretty clearly a blow off top. I think valuations that are most valuable in a long-term time frame all suggest that we're near the highest valuations in history, if not at all-time high valuations. But you combine that with, over the past 6 or 12 months, we've seen changing risk appetites, investors shifting away from risk. And to me, the combination of those two things suggests that we probably entered a new bear market late last year. And this rally we've seen so far this year is a I mean, I can't call it a typical bear market rally, but it does what bear market rallies are supposed to do, which make you believe that there is no bear market. So I think that's where we're at today.
Why do you think it's atypical?
I think it's just because it's been such a strong V bottom. I was looking at rallies in past bear markets, especially early on in bear markets, and I was using kind of an early 2001 analog for a while, and then also kind of in early 2008. And for a while, we looked really similar to the early 2001 period, but this rally's been stronger than your typical bear market rally, not in terms of the percentage gain, but in terms of how much of the losses have been recouped.
So the market sort of topped out about September last year, and so now we're 6 or 7 months into it, which is pretty typical behavior, that there's often that little initial sell-off, there's a rally, and then it sort of seems to drift sideways for up to a year or more before you really start seeing the carnage. Is that what you're expecting to see? And what would cause you to think that it was back on?
Well, the analog that I'm using right now, price analogs are one thing that I like to use. And actually, this was one that Ray Dalio brought up 3 years ago. It was a 1937 analog. And the historical parallels are just fascinating. But the price analog is actually very, very close, too. You look at the past 1 year and 3 year price patterns, and there's like a 97% correlation between today and 1937. And so that would suggest if that price analog is valid, that prices should return to the lows pretty quickly here. And so that's one thing that I'm looking at. But I really do think what the market's trying to price in right now, or what investors are counting on, is a second half rebound in earnings. And I think as we start seeing this, first quarter numbers come out and start hearing more guidance from companies, if that second quarter or that second half rally in earnings or rebound in earnings doesn't materialize, it looks like it's not going to materialize, that's probably what the market's going to have to start pricing in again. And if it looks like that, and the companies that have come out recently, especially on the semiconductor side, it doesn't look like there's any second half rebound on the horizon. And so I think once the market starts beginning to price that in, that's the catalyst for a return to the lows, and then kind of see how the market behaves there.
What was the final result in 37? How far was it down from the peak?
Gosh, it was another 50-60% decline. Back then, the price analog that I'm looking, when you line them up, it doesn't suggest that much of a decline. It suggests we take out the lows from last year, but it goes more back to like the 15-16 highs would be kind of the extent of that if the price analog is valid. So.
That's an interesting time period, and I'm glad you brought that one up, because I think I had been following you for a little while, but that was when in 2014 you started your 10% drawdown beard.
That's right.
And that was reaching sort of ZZ top proportions before we finally got that drawdown. So how long? Take us through that. That was a fun period.
Well, yeah. So that was like it was actually August or September of 14, and we hadn't had a 10% correction right since 2011 or something like that. It had been typically the market has one every year, and it hadn't had one for a number of years. And so I thought, we're getting close. We have to for a number of reasons. I was expecting the breath warnings in the market. So I said, hey, I'm not shaving until we get a 10% correction. And then in September of 14, the market went down 9.8%, like literally right after. And people were telling me, Jesse, okay, go ahead, round up,
you can
shave
take
it off. I said, no, that's not it. That's not it. And so it wasn't until August of 15 when the market actually had its and that was a steep sell-off. So it was 11 months of beard growth, and it was definitely ZZ top at that point. My wife was very happy.
To the great relief of your wife.
Right. Yeah.
So you proposed to her the 20% drawdown beard, and she said no chance.
That's right. Exactly right. I did that last year or something. She goes, nope, that's not happening.
I noticed. She knows the market too well.
Yeah.
So the thing that has been most amazing about this market, would you have thought at that time that we'd be this far into it without really seeing that debt clearing crash or decline? Would you have thought that would have taken this much longer, or we still wouldn't have seen it?
No, and I thought that 15, 16, the late 15, early 16 correction was probably the beginning of a new bear market. There's been a lot of speculation of what prevented a bear market at that time. Clearly it wasn't. We did have an earnings recession, and some people even believe we probably had a mild economic recession. It was mainly an oil-focused thing at the time. But yeah, I was surprised. But then when you look at Trump getting elected and the deregulation and tax cuts that went along with that, that essentially extended the cycle. And that's the thing with the famous thing everybody says about markets is they go a lot longer. Bull markets, trends in both directions go longer than you would ever imagine they could. So yeah.
But this market seems to be supported on. The multiple is very high, but earnings have also been very high for the S&P 500. Margins have been very high. It's sort of at every part of it that you might want to look at, it all seems fairly extended. And if any of that came back a little bit, you see some pretty substantial drawdown in the market at least.
Well, I think you hit on it. That the number one thing that I'm paying most attention to right now is margins, because by on earnings-based measures, stocks don't look extremely overvalued, but on sales-based measures, they do, and the difference is profit margins. And so I think a lot of people who are using earnings-based measures don't really understand this, that well. That if you're using an earnings-based PE to ratio, what have you, you have the embedded assumption that profit margins are going to remain at record highs indefinitely, that there will not be any reversion in those. And historically, Jeremy Grantham has said that's the most mean reverting series in finance. Warren Buffett wrote about it in '99 in one of his articles for Fortune, where he talked about, he said, something along the lines of, you have to be crazy to think that corporate profits can remain over 6% of GDP for any extended period of time. And he goes, so he was wrong about that, because profits have, remained higher than that. But he was right in the fact that he said, if you were to see a situation like that, it would create all kinds of political problems. And I think that's exactly what we're seeing right now with global, populism on the rise. This is, the labor share of corporate profits is at record lows. That's the inverse of corporate profit margins. So corporate profit margins are only so high because labor has been getting a much smaller share than they ever have historically. And so now labor is essentially revolting, and through politics. And so, you have, Ray Dalio's partner at Bridgewater, I'm spacing on his name right now, said that there's all these forces right now that are working against corporate profits. And I think if you look at what's going on politically in that light, then you start to see the risk to profit margins and the risk to valuations over the next several years. And people don't understand the risk. I mean, if profit margins revert to historical norms, then you're looking at an S&P 500 today that's at a 40 PE, higher than the dot-com mania. So, that's why my friend John Husband has come up with, one of my favorite valuation measures is a margin-adjusted CAPE ratio, essentially. And when you adjust for profit margins, stocks today are higher than they were in 2000, higher than they were at the peak in 1929. And so I think investors who are using earnings-based measures need to be really, really careful about profit margins. What is the embedded assumption that I'm making in profit margins today, and is that a safe assumption to make?
The bulls would say to that there are two arguments for the higher than usual profit margins and sustainably higher than usual profit margins. One is that we're transitioning to a more asset light economy, and that might warrant higher margins, or they're able to generate higher margins. And the other one is that it's a global world, and the profits that US companies are earning are typically foreign. There's a lot of foreign profits in that mix, and so there's no reason why it should be constrained by those old labor profit margin ratios.
I think the real way to explain it is the change in the antitrust framework over the last 25, 30 years. We've had this rise of oligopolies that have essentially colluded to set pricing, whether it's in the airline industry or what have you. I mean, I had Jonathan Tepper on my podcast. His book, The Myth of Capitalism, is fantastic on this topic, and I really think that is probably the main driving force that has led to these winner-take-all type of profit margins. But that's exactly what we're seeing in this political backlash right now, is a direct attack on that framework. So we're seeing a total rethinking of the antitrust framework. You have Elizabeth Warren talking about breaking up big tech, and that becoming the foundation for a political platform. And it's not just her. It's in fact, to me it's fascinating to watch the bipartisan support for this anti-tech movement, and because those are really the companies that have the biggest profit margins and cash piles and those kinds of things. And so to me, I think this is what Bridgewater's talking about when they say all of the forces that are working against corporate profits. It's really a groundswell of political movement that's moving to take back on behalf of labor what they've lost over the last 20 years.
Your Twitter account, you do have a theme of some distrust of some of the social networks, Facebook and Google and so on. What's the impetus for that, and what's the solution? Is it breaking them up?
For me, it was I got off Facebook years ago when I just started realizing it didn't make me feel good to be on there. And Twitter, you could get the same feeling to be on Twitter too, But I find Twitter, immensely valuable from the standpoint of being able to follow people like you, Toby, and I follow about 100 accounts. And to me, the information that those accounts provide me with is invaluable. But I do think, the problem with social media is that it's become far, far too powerful. I think we underestimate social media's ability to get our attention whenever they want, and then manipulate our attention in ways that everybody says, no, this is not happened to me, right? I'm invulnerable to this kind of stuff. But all the studies show that whether it's manipulating people to vote a certain way or to buy a certain product or what have you, the data collection and then the use of it to manipulate people's essentially free will is gone way too far. And that needs to be reined in. And so I think, I don't know if it's breaking up these companies, but, I had Roger McNamee on my podcast a couple of years ago, and we talked about this when this was first kind of breaking with Facebook.
It's a great podcast.
Yeah, he thinks he's an amazing guy, and it was really, really fun to do that. But he thinks the business model just needs to be changed, and I do agree. I think when you have such powerful platforms as YouTube and Google search and Facebook, Instagram, and their ability to manipulate people, and there's a profit motive behind it, the problems that can arise are unimaginable and very, very serious.
Just returning to U.S. equities, are there any industries or sectors in U.S. equities that you like? I know I saw you tweet out that bank stocks are the P's of bank stocks relative to the market are as low as they've ever been.
Yeah, I think it was Dryhouse chart that they shared, and I thought that was interesting. In some ways, I feel like this current situation we're in terms of valuations is very similar to the dot-com mania. And back then, there were a handful of stocks that I was finding. I mean, value, I think the similarities there was growth was so popular, value was left for dead. And I think we're seeing something very similar right now where there is some true value out there, and it's just being left for dead. For me, financials, a stock that I bought in late 90s, 2000 was Washington Mutual when it was just a simple thrift, and the stock was trading 5 times earnings. And that financials have been crushed then because of the same situation that's going on, which is the flattening yield curve. Net interest margins are squeezed, and so that hurts earnings, and financials get hurt. Stock prices. To me, that was a very easy investment to make because Washington Mutual was literally just taking in deposits and lending it on home loans, and they hadn't gotten into any of the other types of interest rate hedging or things that they got into later on when they hired one of the top guys from GE. And that's when I sold the stock. I thought when they created this derivatives portfolio and it grew in the tens of billions of dollars, I said, I don't understand this. I have to sell this stock. But it was a good investment for a period of years. Today, to me, one of the lessons I learned in the financial crisis was a lot of these banks are black boxes that not even the top executives at those companies really understand the risks they're taking and that sort of thing. So it's really hard for me to invest in bank stocks today when the business is so complex that not even they understand what's going on. I mean, even for years after the crisis, I remember these companies would announce earnings and then have to restate them a month or two later because, whoops, we miscalculated this and we didn't understand that. Like, if you guys don't even know what's going on with your books, how can I have any confidence? So it's interesting. Financials might be cheap right now in the banks. I think if you have a well-run bank that's cheap, it's probably a good opportunity today, especially, usually in this situation, my experience, when the yield curve flattens to the extent that these companies get hammered, it's usually an opportunity. But I have a hard time with those companies for those reasons.
I've noticed that there are a number of commercial banks that have come into my screens recently. They're sort of taking up 15 to 20% of the slots in the screen. So that leads me to think that there might be something worth investigating there, but I haven't looked at them in any great detail. So I tend to agree with you.
Yeah, well, one other point I'd make is one of the things that I followed, since the start of my career is insider activity, and I haven't seen any significant insider buying at any of these things yet. And so, one of my favorite books is Reminiscence of a Stock Operator, and in that, Jesse Livermore says, when a stock gets cheap, the top management will never fail to buy because they know that it's a great opportunity and they know they're going to make a ton of money. So when I find a value opportunity and there isn't insider buying, to me that's kind of a red flag. Why are these guys not putting their money where their mouths are?
Or buybacks, which is another favorite topic of yours. So let's talk about good buybacks and bad buybacks.
Right. Yeah. I mean, there's good buybacks. For me, that was something that I followed for a long time through my career. Because I remember, Devon Energy during, 2001, 2002, natural gas prices were super cheap. The top execs started buying stock themselves and announced, they were going to buy back 20% of the outstanding shares. To me, that was a great confirmation of this stock is cheap and they're bullish on natural gas prices and all that. But today, what you see a lot more often is, buybacks announced. And then as soon as the company starts buying back, top execs just start dumping stock right at the same time. And so to me, that's not so much of a bullish signal as it is we need a buyer so we can sell, And so, it's interesting to me too. That's another one that Congress is looking into because, there's studies show statistically insider selling goes up 5-fold during buyback periods. And to me, that's just a clear sign that these companies the executives are using the buybacks to help prop up stock prices so that they can cash out, which is, to me, if that's a company I'm invested in, I would not be too happy about that.
They have some restrictions and some limited windows where they're able to trade, and so you would hope that when the company's doing the buyback that any market moving information has been properly disclosed. So that might describe the reason for it. I think buybacks in aggregate tend to be value destroying because the bulk of the buybacks happen when stocks are expensive and then they disappear when stocks are cheap, when ideally you want to around the other way. So you can if you can find that rare management that buys stock back when it's cheap and issues it or doesn't buy it back when it's expensive, then that's a good opportunity and that's a management worth following. But in the aggregate, I think they're probably not good for investors.
You want your, management to be good capital allocators. You don't want them to be burning cash by buying back stock at top valuations, that's one of the things that we're seeing with companies today. I look at, some of these stocks in the Dow. I wrote about the McBam stocks, McDonald's, Caterpillar, Boeing, and 3M. And this was a year ago, and back then, each one of these stocks on a price to sales basis or enterprise value to revenues was trading at the highest valuation in the company's history, and some of them twice as high as they'd ever traded in their history. And you look at the buyback activity and you go, how did they get that expensive? Well, they're buying back more stock than they've ever bought back in their history too.
Right.
So it's to me that's representative of what's going on across corporate America in many ways. And so, it's rare to find those companies that do the right thing at the right time on behalf of shareholders. And to me, where you find that usually is where you have owner-operated companies, right? You have guys that have a large equity stake in the company and their interests are truly aligned with shareholders, not just through, option compensation, which they want to offload at some point. It's the owner operators that seem to make the right choice, and it's interesting to me that these indexes now that they're float adjusted systematically underweight owner operated companies and systematically overweight companies that are not owner operated, and to me that's a potential problem with passive investing today. Also, people don't necessarily appreciate.
That's a very interesting point. I hadn't thought about that before, but that's a fascinating point.
It's something that Steve Bregman I had on my podcast a couple of years ago, and he was. I don't think people appreciate the fact that it was 2004 or 5 when they actually changed the index methodology from just cap weighted to float adjusted cap weighting. And still they use the track record of the S&P 500, back as if it was just cap weighted, prior. But today's not cap weighted; it's float adjusted cap. And so, to me, philosophically too, that goes exactly opposite of what I'm trying to do. So you have companies where there's massive insider buying and they're reducing the float. So the index has to underweight those companies to some degree, and companies with massive insider selling. Right, they're expanding the float, and so the index is now saying we're going to buy more of these where there's insider selling, or we're going to buy less of these where there's insider buying. The greatest example of this is probably Intel. Go look at Intel, a stock chart of Intel, and you look at the chart from when it went public, when Andy Grove was running it and had a third of the shares personally, to 2000. Stock was, went up like 30% a year for that period. Andy Grove retires as chairman and CEO, sells all of his stock, and Intel today is still down like 30% from its 2000 high. So you look at that period of, the mid 80s or whatever to 2000 and you go, okay, this is what an owner operated company does, right? He's going to make me 30% a year. And I've lost money in the 20 years since it's been a non-owner operated company. And the way the passive, methodology now works is that entire time Andy Grove owned a 30%, the shares, we're going to underweight Intel because of the float. As soon as Andy Grove goes and sells all of his stock, boom, now we're going to overweight Intel because the float just went up a ton. And so to me, it's a philosophical problem with passive that a lot of people don't appreciate.
It's a perverse incentive. You're incentivized to issue more stock that's not held by the owner.
Right.
Held by the main shareholder.
Right.
You and I were both tagged in a question about Boeing, where Boeing's off a little bit because it's had the two plane crashes, and both of us sort of agree that it was extremely overvalued. I was looking at my favorite metric, which is the acquirer's multiple, and then you said you agreed on the basis of revenues to enterprise value. And so I looked at that chart, and that was a striking chart that a few years ago Boeing sort of took off in terms of that enterprise value to revenue metric. And then I've looked at several other companies, and that's common to a lot of companies, that they've all got extremely expensive on an enterprise value to revenue basis. How do you account for that? Is it just the margins, or what's going on there?
I think in some cases it's the margins. But the reason I like to look at that metric is because, I've talked with Eric Cinnamon a ton about this, and he's another fantastic investor, very successful guy who normalizes profit margins in his valuation process. Because if you look at a company that's maybe looks cheap, but profit margins are at all-time highs for whatever reason, you have to make a decision on, are those profit margins going to normalize, or have they literally entered a new era? And 9 times out of 10, profit margins will normalize over time. It's just the nature of competition. And so I see that with a lot of companies, and that's why I'm using enterprise value to revenues a lot more these days, is because I want to see, that's basically just the easiest way for me to normalize for profit margins. And I think in a lot of cases, it's growing profit margins, but in a lot more cases, this is another thing I think equity investors don't appreciate. There's been this huge debt for equity swap where companies have been issuing tons of debt to buy back stock. And it makes the stock, potentially look cheaper. But when you look at something like enterprise value, you go, okay, wow, but the debt has gone through the roof. And, that's why I love the acquirer's multiple. If you think of a company as an acquirer does, and I think you have to be successful over a longer period of time, you have to take the debt into the equation. And so when you're not doing that by just looking at just a simple price to earnings ratio or that sort of thing, you're completely missing this dynamic that's happened, which tons of companies, especially small cap companies, this has really been more of an important dynamic where companies have just issued tons of stock or tons of debt, to buy back stock, and it makes the stock look cheap. But in terms of the whole, the holistic valuation, the debt has gone through the roof, and so the valuation of the whole enterprise has gone very, very high for the simple fact that I think equity investors aren't paying attention to the debt side of the equation.
That was another tweet of yours that I remember looking at, was looking at the Russell 2000 in terms of enterprise value to EBIT. I think that was the metric, or could have been EBITDA, and that's been I think it's traded around sort of maybe a multiple of like 12 to 15, something like that. And over the last few years, it looks like it's at 35 times now, which looks like it was unprecedented in the data or in that chart, which I don't recall how far back it went, but it was 20 or so years.
Right. I mean, yeah, and I think that was a chart from Eric Cinnamon, and it's fascinating when you look at price. That's similar to looking at like the median price to sales ratio and these types of things. They all show, smaller companies especially are extremely overvalued, and perhaps more than overvalued than they've ever been in history. And this has got to be, the passive dynamic, right? So you have big companies that can, absorb flows, passive flows. But then when you have passive flows going into a small cap index, those companies can't absorb the flows, without pushing prices higher. So, this dynamic of, so much money flowing into passive, I think, is directly responsible for the valuations we've never seen before in these smaller companies.
It's one of the things that I certainly didn't realize until I saw the statistic, but of the top 3,000 companies, the Russell 3,000, so the Russell 2,000 is the smallest 2,000 of that top 3,000. The total market capitalization of those 2,000 companies is 6% of the 3,000. So the Russell 1,000 is 94% of the capitalization. The 2,000 is 6%, which is why if they get a little bit of flow, it makes them go haywire.
Right. Yeah. And, the other thing about those companies, too, is they're so highly indebted, too. So the equity valuation has gone so high, and they've also piled on all this debt. That's why when you look at things like enterprise value, it's like, oh, my, it's off the chart.
So that makes the debt makes them susceptible to a recession. So what sort of indicators do you look at to determine whether we're in a recession or not, or whether one is approaching, and what do you think about our prospects?
Yeah, it's so tough to try and game whether recession is coming or not. To me, I think some of the work that Robert Shiller has done is really, really interesting, and it kind of relates back to Soros reflexivity theory, which is all of these things are interrelated, and recession is as much a psychological phenomenon as anything else. And so falling. I think a lot of people say, well, that's fine. I'll just be, super long overweight equities until we get a recession, which they don't necessarily appreciate that falling equity prices can actually precipitate a recession. And when you look at the correlation between, equity prices and, consumer confidence, it's one for one. And so I think that's kind of one of the things that, Shiller's been talking about recently, which is, we can talk ourselves into a recession pretty quickly. If people just start, we have an earnings recession, I believe, we're already going to have, negative earnings growth in the first quarter, probably carried through to the second quarter. And so, that sort of thing, if it really results in falling equity prices and falling consumer confidence, it kind of can snowball into a recession pretty quickly, especially 10 years into an economic expansion. So, it's not something that I try and game necessarily, but I do very closely watch the semiconductors, and I think they're, because semis go into everything now. They go into autos, they go into all kinds of things, and so semiconductor sales now are falling 20-30% year over year, and to me that is that hasn't happened since the last recession. And they're kind of the canary in the economic coal mine, or at least the earnings growth coal mine for me. The last earnings recession was really just oil kind of driven and relegated to that sector. This one, we're now seeing technology stocks are leading the earnings recession, and it's much more broad based. And so I do think that creates its own risk of kind of a self-fulfilling prophecy of recession.
Just to go back to something that you said earlier, just eyeballing it, I've never sort of done the work to determine if this is the case or not, but just eyeballing it, it seems to me that equity prices seem to lead recessions. You get the fall off in the crash happens before we're officially recognized as being in a recession, and it happens the other way too. We seem to recover in the markets before the recession is officially ended.
Well, yeah, I mean, and I think people wonder why the Fed is so focused on stock prices, and it's for that very reason, that they know that falling stock prices can hurt consumer confidence and create a recession. And so it's kind of the tail wagging the dog, right? You think stock prices should, but I mean this is Soros reflexivity theory that not only does what's going on in the economy affect stock prices, what stock prices do can affect the economy. And so I think that is a very good point. And people who say I'm waiting for a recession to back off my equity exposure are
too late.
I mean, right. And evidence of that was the last two recessions where stock prices were discounting it well in advance, and even probably exacerbated the consumer confidence that really led to the recession. So yeah, it's stuff to pay attention to, but it's really kind of all you can do is really kind of pay attention to how those things develop through time rather than trying to forecast them.
What about something like the yield curve that's recently flipped and it flip-flopped a little bit? Is that is that a near-term indicator, or is it something that's worth paying attention to?
So many people talk about it as just an indicator. To me, I always want to find why should this make intuitive sense, right? Why should I use this as an indicator? And I think I wrote about it maybe a year ago when we first started, getting pretty flat on the yield curve. And it makes sense. I mean, we talked about the net, squeezing net interest margins. And if you think about it in terms of that, a flat yield curve, it's like, banks, why should we lend long when we can, we can just buy, short-term debt and make just as much money with less risk. And so I think the yield curve probably is indicative of what's going on in the credit cycle. A flat curve is going to lead to a lot less interest on behalf of lenders to lend. And so that creates a tightening of credit on its own. And so I think it's probably valuable as an economic indicator for the fact that it's going to determine what's going on in the credit cycle. So to me, yes, I think that's important, but also these effects, take a long time to work through, right? So if lenders, now that the yield curve is inverted on some, levels, are saying, okay, it doesn't make sense for us to really expand our loan book, that's going to have ripple effects over the next 3 to 6 months. And so I do think it's valuable, but for the standpoint of it, kind of helping tell you where you are on the credit cycle.
The Fed seems to, at last year, it looked like it had this longer-term plan to very modestly raise interest rates over an extended period of time. And then when the market sold off last year, I think we were only down something like 20% at the lowest point. It looked like the rhetoric changed and possibly the behaviors changed. Do you have any view on whether how they're managing the economy and whether Powell's doing a good job?
Yeah, I think what I come back to is right after the financial crisis, before Janet Yellen became Fed chair, a few years before she became Fed chair, she was interviewed and for the what was it? Money for Nothing was the documentary, great documentary on the Fed and their role during the financial crisis. I think Michael Lewis's book was fantastic in kind of discussing the dynamics of what led to the housing bust, but he leaves out the role of the Fed. And Money for Nothing is a very important film, I think, in kind of detailing the role of the Fed in that. And Janet Yellen right after said we need to find a way to get our economy growing naturally and not be so reliant on financial bubbles. And so I think she was right then, just honest, because she was in a position where she could be honest about it, in saying that, we had the dot-com mania, yes, and that was, great for the economy until it bust. And then we had to engineer a housing bubble to try and rescue us from this dot-com mania bust. And then when she became, Fed chair, obviously she did her best to create a wealth effect and try and engineer higher asset prices. And I think, the Fed is very well aware of the fact that because they've talked so much about a wealth effect, they're very well aware of the fact of asset prices on consumer sentiment. And so I do think that it seemed like, Jay Powell, when he first took over, was set on trying to normalize monetary policy from something that's been abnormal for a decade and extremely abnormal for a decade. And then when he saw what it was going to do to asset prices, he said, wait a second, I can't do this because, but I do think we're moving towards a time, and Alan Greenspan has said this recently, that we are staring stagflation right now in the face, and we're headed to a time of higher inflation and weaker growth. And if that's the case, and I do believe that's the case, that we're seeing a new inflation framework that's very long term in nature, but it's just kind of growing now. Then the Fed is going to be forced to either start fighting inflation or trying to prop up the market, and they won't be able to do both. And so, and with this talk of modern monetary theory and these types of things, the Fed has come out, and I think they're deathly afraid of this because it's essentially fiscal dominance. It's essentially, you guys can't pursue the policies you want anymore because the fiscal authorities are going to go nuts and force your hand. That you're going to have to monetize this debt and fight inflation and do these things, and they're not going to be able to pursue their own agenda anymore. And so I think if that's the direction that we're headed, then this idea of the Fed put is going to go away. Right now, Jay Powell's trying to have his cake and eat it too, which is I'm trying to preserve the Fed put, and I'm also trying to let people think that I'm going to keep inflation in check. And right now, the oil price being down, he's kind of that's giving him some cover to allow inflation to try and pick up. But if inflation does start picking up, that could be what leads to the expiration of the Fed put.
If we go into that 70s style stagflationary environment, it becomes extremely difficult to find good places to put your money. That period, I was going to say I don't remember it. I was alive, but I wasn't investing. Terrible for equities. Equities got destroyed on some of the nastiest bear markets that we've ever seen. Terrible for bonds too. Really, the only place to hide was precious metals and commodities that did seem to perform fairly well through there. So, and through that period, no lesser investor than Buffett could only just keep up with gold. So how do you feel about the prospects for gold and other precious metals and commodities in general?
I'm very bullish on gold, not necessarily because of inflation, but because of the fiscal situation. We're already running trillion-dollar deficits. And there's talk about expanding those. I think we're headed towards 5 to 6% of GDP on the annual budget deficit. The dollar is very highly correlated with the budget deficit. So, the dollar was very, very strong in the dot-com mania. We had actually a fiscal surplus. And then during the recession, we started getting deficits. The dollar turned down. Obviously, we had massive deficits after the financial crisis. The dollar tanked and gold did really well until about 2011 when the deficit started narrowing again. But right now, this is one of the rare times in history where we have a widening fiscal deficit during an economic expansion. And so we're already plus, $1 trillion on this thing annually. And if we get another recession, we're going to see $2 trillion deficit pretty quickly. And that's even without any more fiscal stimulus. We have talk about, the Green New Deal and these kinds of things, which are massive spending programs. If we get these, we're going to just see, this widening deficit. And it's very bearish for the dollar longer term. And I think the only way, if you are a dollar-based investor, to protect yourselves is to have some kind of allocation to gold. I think, Ray Dalio has said, if you don't own gold, you don't know history. And I think that's really important, that right now, a lot of the talk in Washington, I think for the first time, maybe in my lifetime, you have bipartisan support for expanding, fiscal stimulus and not any worry about the debt. You don't even have people talking about, how worrisome the debt is. And so throughout my entire lifetime, people have been worrying about debt, and the debt's too big. And now all of a sudden that worry is gone. And to me, that's troubling, right? So I think that you have to have some kind of a gold allocation to protect yourself in that environment.
Gold seems to have struggled through a period where there has been an enormous amount of money printing, and not just from the US, from every other central bank around the world. And the debt, which I think it should matter, but it doesn't seem to have impacted the economy. It doesn't seem to have none of the risks that people said were out there seem to have manifested, and that might be why it's gone away. But is it just that it hasn't happened yet, and that it's something that we're still to see?
Yeah, I think we've had this disinflationary environment for 30 years. And so, and it's a combination of things. I think it's demographics, right? You have the baby boomers coming into the workforce, which is increasing the supply of labor. At the same time, we have globalization and offshoring of labor, and so this is how companies have been able to take down labor share. It's a combination of the demographics and then globalization, offshoring of labor, and those have been two big forces in I think this disinflationary environment. But demographics are now shifting. Baby boomers retiring, and we're seeing these political forces I talked about, nationalism, and you're even hearing talk about deglobalization. And so, to the extent that those trends continue to gain traction, with baby boomers retiring and these things that brings back kind of an inflationary impulse. And so, right at the time when 30 years of disinflation or whatever has lulled people into thinking debt is not problematic, we're potentially seeing those forces reverse into a more of an inflationary dynamic. And, that's the one thing that could make, debt really problematic, is that, interest rates start rising and interest expense, to the government goes through the roof. And so, to me, all those things together means you should definitely have some gold in the portfolio.
What do you see as the sort of catalyst or tipping point for something like that, and how sort of near term is something like that?
To me, I have a longer term time frame than most people. Most of my investments are equity investments are like 1 to 3 year type of things, but a lot of the stuff I'm looking at is more like 3 to 5 to 10 year type of trends. And so, I think this is something to pay attention to. It's a very long-term dynamic, right? So I've actually been, short-term bullish on bonds just because of what's going on in the economy and the oil prices, come down. But longer term, I'm bearish on bonds. And when I say longer term, I'm saying over the next 3 to 5 years. And so I think this is something that will take some time to play out. This inflationary dynamic, it's very, very long term in nature. It might be a 20 year, 10 to 20 year type of dynamic. But it really, I think it all depends too on how much debt we start to issue, how much fiscal stimulus we start to see, and what goes on in terms of risk appetites around the world too. So all those things are kind of unknowable until we see how they play out.
One of the indicators that you watch, the M1, seems to be at the lowest level since the last Great Recession. What is the M1 and why do you pay attention to it?
Well, the money supply is something to pay attention to. It's actually not something I pay, super close attention to. The rate of change is important for various reasons. But yeah, it's actually not something that I pay a ton of attention to be honest. I like indicators that are much more tactile, I guess, things that have a direct bearing on investments on a day-to-day basis. So a lot of the macroeconomic stuff to me is not as valuable as where's the dollar going, that type of thing.
So what are your preferred indicators? And so what are you looking at? So we know that the market's expensive because we can look at, you can look at CAPE, which is just inflation adjusted earnings to the price. So you can look at Tobin's Q, which is replacement value of assets against their market value. Or you can look at even Buffett's favorite measure, which is just total market capitalization against gross national product, I think, which is just the size of the stock market relative to the size of the economy. All of those look at three different, very, very different aspects of the market, and they basically all give you the same answer, that the market's extremely overvalued. But it's been that way for an extended period of time. It's been that way. Maybe it's sort of left the long-term averages in 1996 or the late 1990s, and then at various points through there, we might have touched long-term averages in 2009. I don't know if we got that cheap in the 2002 recession, or the 2002 decline. But it's one of those things that I believe that the market is extremely expensive, but I'm also a value investor, so I'm less interested in where the market is. So I'm more interested in what the value stocks are doing. And you mentioned this a little bit earlier, that it was sort of an analog to 2000, where the market was expensive value stocks were cheap. I think we're in a situation now where the most expensive stocks are at extreme levels they're as expensive as they've ever been. The median maybe not as expensive as it was in 2000, but on some measures, using sales, for example, it is extremely expensive. The value stocks aren't that cheap on historical measures. They're still at a premium to where they are on average, but they are cheap relative to expensive stocks. So my question is, what are the indicators that you like to look at for your own portfolio? And those are sort of valuation indicators. And then what indicators are you looking at from a, when or a momentum time? Like what's your timing indicator?
Yeah, so you're absolutely right. And I mean, it's become a mantra of the bulls, which is, valuation is not a good timing tool. And that's absolutely true. I think what are good timing tools are breadth and risk appetites. And so those are two things I watch very carefully. Late last year in September, I was writing about how many Hindenburg omens were being triggered on the NYSE and the NASDAQ. Absolutely astounding, more than we ever saw in history. And you see these bursts of Hindenburg. And a Hindenburg omen is essentially alerting you to great disparity in the market. So when the market is strong, it should be powered by most of the stocks in the market. You get a Hindenburg omen triggered when the market is rising, but fewer and fewer stocks are actually pushing it higher. So it's essentially a breath warning. And I don't use it as like one Hindenburg omen is going to, signal a crash like some people, talk about. I want to see how many Hindenburg omens are triggered in a period of time. And that tells me that, breadth disparity is widening. And in that fall of last year, we saw record numbers of Hindenburg omens triggered on the NYSE and the NASDAQ. It told me there's huge breadth disparity in the market right now. It might be powering higher to new highs. But the NYSE didn't make new highs, even while the NASDAQ did and the S&P did. And that was kind of another, sign. So breadth can be an important warning, and then risk appetites also, right? So you want to see the right sectors powering the market higher, right? Like today in this rally, right, we're seeing the utility stocks do phenomenally well. That tells me that investors aren't really keen on taking risk. They're acting much more defensive. So when you see staples and utilities and these things kind of doing really well, and you see consumer discretionary and technology and these things doing relatively poorly, that's a clear sign that investor risk appetites are shifting. They're not embracing risk like they should be at that point in the cycle. And so when you have the breadth and the risk appetites both pointing, or kind of diverging from price, that's a pretty good timing tool that the market is pretty close to a reversal. So you can use those on multiple time frames too. But that's also one of the reasons why I've said the market is in a topping process, is because we've seen these massive number of breadth warnings over the past year. We've also seen risk appetites shifting pretty dramatically, like we've seen at past market peaks. Now, for me in my own portfolio, things I look at for value, and I think where the greatest value is to be found are in things that are kind of outside. So these owner-operated companies, right, that are systematically underweighted by the indexes, so much money is flown into passive and flown out of active that these stocks have been essentially been forced to be sold by active managers, and they're not being bought by passive because they're low float. And so that's, I think, kind of systematically one area where you can find value. But to me, there are pockets of companies too, where I look for a situation where there is massive and predictive insider buying. So you have an executive who has a good track record of buying their own stock, and they're buying a significant amount. And that to me will hopefully confirm my idea that the stock is already cheap. And in terms of cheap, I use a variety of different measures. Basically, I look at the valuation history of the company. I look at its valuation relative to its peers. And I'll also do usually a discounted cash flow model, basically just to try and confirm my idea of what fair value is, or even just to see what is the stock price discounting right now. So I don't use the cash flow model as a primary valuation tool. And then I'll use technicals to see, what is the trend, what is the strength, what is momentum. Usually I use technicals mainly for momentum. I don't want to buy something that has strong downside momentum. I want, if it is still falling, I want to see waning momentum that shows me signs that, sellers are kind of running out of steam. So there are things. I think one of my favorite ideas that I've had over the past, few months has been Post. Bill Sturritz is maybe the most successful insider I've ever seen in my career. And the guy, when he took over Ball Corp in the late 90s and bought $40, $50, $60 million worth of stock with his own money, brought in his own management team. They all bought as much stock as they could afford. Ball Corp's up 40-fold in the last 20 years. So Bill Sturritz, also turned me on to Herbalife a couple of years ago. I bought a big slug of Herbalife in early 2015 when he had nothing to do with the company. And I really think that's part of maybe the thesis behind Post today is he saw a company like Herbalife, if you have 80% gross margins, you can't go out of business, right? If I have 80% gross margins and I have no debt, I literally can't go out of business, right? I can have idiots running the company like Buffett says, and it's really hard to hurt the business. And so Post recently has started selling their own kind of a protein powder shake type of a thing. And with their access to grocery store shelves and that type of thing, I think Sturritz said, wait a second, 80% gross margin. That's awesome. Why don't we come up with something at Post? It's not Post branded. But I do think, he owns a ton of stock and was buying more last year. And the stock is still, cheap relative to its own history, relative to its peers. That's the kind of thing that I look for. And then because of my concerns about the overall market, I'll look to hedge that in some way against general market risk.
How are you hedging? Just with it, how are you hedging?
Well, I'm short. So I usually short individual stocks, but in very, very small size. I don't like to short individual stocks. I'm not as aggressive as I am on the long side in that respect. I usually kind of just short the broad indexes and sometimes sectors. And so I am short the semiconductors pretty heavily today right now because talk about, companies that are trading at the highest valuations in their history. A lot of these stocks are trading. NVIDIA, for example, I was short NVIDIA last year. I'm still short it. Was trading at twice its valuation from the peak of the dot-com mania, which is hard to believe, right? It's trading 15 times sales when it only got up to like 7, 8, 9 times sales in the peak of the dot-com mania. And so what is that stock discounting? It's discounting that company's going to take over every self-driving car, every AI application. I mean, they're literally going to own it all and be able to keep incredible margins in the process. And really what was driving a lot of their sales, I think, over the past, couple of years is Bitcoin mining rigs. And so when the Bitcoin price collapsed, a lot of those that chip shortages, turned into, chip oversupply. And so they weren't talking about that very much in terms of their earnings calls, but, that was the extra factor to, demand factor that really, pushed the results over the top. And now we have this massive, chip oversupply and, sales are plummeting. And so I want to be short. I'm short the semiconductor, ETF against, some of my long ideas. But I do think, for the average investor, and you and I have talked about this, there's simple tail hedging methodologies that people can use. And to me, when I suggest that, people say, well, God, that's so bearish. Why don't you just buy and hold for, long periods of time? And I go, well, you buy auto insurance, right? You buy homeowners insurance. You protect yourselves in the case of an adverse event in those areas. With equities at the highest valuations in history, it would make sense to me to buy some insurance against my investment portfolio, just like I would with anything else. And that's how I look at tail hedging. I think it makes a ton of sense today, maybe more sense than it's ever made before. So, there's simple tail hedging strategies you can use to buy deep out of money puts on a monthly basis, and it's just look at it as an insurance policy.
One of the things I like about tail hedging is that often it gets cheapest right at the moment that you really want it. So it's often the best bang for the buck. And I've done various things. I had HYG, which is the junk bond ETF. I had puts on that last year that they were up a lot when the market was off, but I wanted to hold them through to expiration January 20, and of course they were 83. They were struck at 83, and I bought it at 85, something like that. And then by the time they expired Jan 20, they were out of the money, even though they were up like 350% plus on December 24. That was a rapid rally. I was sad to see them go.
Right. Yeah. Well, I mean, it's funny every time I've made a decision, based on whatever tax, thing, I don't want to pay tax. It's been the wrong decision. Right? Yeah. You have to do it on the investment merits first. I've done that a ton of times, and I've learned, take the gain, pay the taxes, you're or whatever. You're better off, in that respect. But yeah, it was interesting too with that sell-off, and I think you and Chris Cole talked about this a little bit. I was surprised that volatility remained so subdued during that sell-off last year. And for that reason, people who were tail hedging, were probably disappointed a little bit to the extent of it didn't really protect them to as much as they would have liked. But that was very interesting to see volatility kind of remain subdued, even though it was a waterfall decline in December.
Chris, I was speaking to Chris as that was happening, and he was pretty. He didn't seem to think that was the real thing, which I was surprised about because I certainly thought it was the real thing, but he was pretty calm through the whole thing, and he didn't expect to see anything, and it was showing up in the volatility as well. It wasn't sort of taking off, and I don't know why that was. Yeah,
it was the exact opposite of what we saw earlier in the year, where you had the volatility implosion, and there was just tons of short covering in vol, and maybe it just was the fact that there wasn't that much of a big of a short position in vol, or. I'm just amazed at how resilient a lot of these volatility short sellers are. Like, they get crushed and then they come right back in and start selling it at the lows. And, maybe they were just, comfortable in continuing to sell vol into that decline, which to me would be, I'm not willing to step in front of that steamroller. But
they've been right over and over again, but none of them have read Fooled by Randomness, evidently.
Right.
I think that's coming up on our time. It's been a really fascinating discussion, Jesse. I really do appreciate you giving me some of your time. If folks want to get in contact with you, what's the best way of doing that?
At thefelderreport.com, I write a blog, and there's a little, contact us there that I reply to personally. So, and I'm pretty active on Twitter also. I don't look at the ats, so don't at me on Twitter because I literally just don't look at them. But you can direct message me on Twitter if there's things people want to discuss too.
You just can't be a bear on Twitter. Bears are excluded from the body somehow. They're forced out. I've discovered that too. Anything that's bearish gets a lot of hate.
Yeah, and so I think Twitter added a feature. Maybe it was like a year ago or something, where you can literally just turn off your ads. So like I only see the ones from the people I follow, and I feel like that keeps me sane. So.
That's smart. That's a smart approach.
Yeah.
Jesse Felder of the Felder Report. Thank you very much.
It was my honor. Thanks, Toby, for having me on. I'm really excited to be on your new show, and I'm a fan. I was really excited to hear that you were doing this, and so I'm eager to hear where you go with this, and best of luck with it.
Thank you.